What's up, everybody, and welcome to the No BS Real Estate Show, a podcast that gives you an inside look on how to make smart financial decisions while adding value to your life. I'm Matty Miller with ERA Real Estate, alongside my co-host and real estate investor extraordinaire, Ryan Robbins. Whether you're a longtime investor or a first-time buyer, join us as we dig through the everyday bullshit of real estate. Our podcast. Oh yeah, the No BS Real Estate Podcast. I'm just kidding. So it's been a while though, so that's kind of why I'm a little bit confused here. It's been December. We apologize for taking a month off. January hit us hard, and that's kind of what's going on. So we're just trying to catch up with things and get back into the swing of it and go from there. So how was your how's your start of the year been so far?
It's been a busy January. So busy 2019, which is good. Normally January is historically a slow month, and
absolutely it
so
is.
Kind of crank things off.
Weird.
Yeah. To crank things off on a high note. That's always good. Busy is good, and especially in the real estate market. So
absolutely. Well, here today to talk about the myths of buying your first home. It's honestly probably a conversation I have, because I work with a lot of renters, first-time buyers, and everything else. It's a conversation that I have probably, I would say, weekly with someone. They're like, I was just talking to a couple yesterday, and they were like, well, they told me I had to have 20% down. And I'm just like, who told you that? And why? There are so many programs out there that would help people purchase their first home. It's ridiculous. Even in an up economy, we're on an upswing economy right now. In a down economy, there especially is. But obviously coming off of 2008, the last 10 years, everybody got $10,000 to buy their first home. So we're going to talk about, or you need to have great credit, or I don't have a 700 credit score. You don't need that either. Okay. So we're going to go through about 6 or 7 myths of buying a home. And some are true, some are not so true. Some people have differing opinions on. And the first one we're going to start with is, it's a great investment. Is it always a great investment? So my short answer to that is no. It may not always be a great investment, because there's a lot of various factors that kind of go into purchasing a home. If you're purchasing a home to purchase a home, and you decide to purchase a condo unit, is that a great investment? I really hate condos personally, because you're at will of the condo association to what happens with your fees. I have a situation with a condo out at the beach where the HOA sued the builder. Now they have a $380 HOA fee every month, and the condos are only worth $120,000 a year. You know exactly what I'm talking about.
Oh, I do.
So you know exactly what I'm talking about, and the guy can't sell his condo. So, and nobody wants to buy in there because of it. So, it's kind of a situation where, and that's one factor. So that's just one example. Typically over the years, obviously, real estate does appreciate, but there are other investments, and you're not going to convince me that's other ways, but real estate all the time is probably the best place to go, but you can certainly buy things that are not going to be great investments for you.
Yeah. And I would say it comes down a lot to mindset, because if you're just your average essentially buyer, which not everybody is involved day to day within real estate and or is looking at it from the investment side of things. So if you're just blindly going out to buy a house because, hey, that's just what I feel like doing in 2019, well, maybe speak to an agent or speak to a broker that's got a little bit more of that investor mindset, because you could end up making a bad buy. Maybe you're going to buy at the wrong time within the market. Maybe you're going to overpay for a house that you can get a better deal, either waiting out until the market cools off a little bit, or maybe you buy something that's undervalued that you can, again, put a little work into and then add value to.
And overpaying for a house, there are people that will do that. But here's the deal. The question they have to ask them is, okay, you can overpay for this house, but are you going to be there for 30 years? Is this your forever house? Are you going to be there? Is this the house you want to, if you're 50 years old, do you want to die in this home? And if the answer to that's yes, then I don't necessarily have a problem with overpaying for something. Given what the market bears. If it's just a perfect situation for you and you overpay for it, no big deal. But if you're overpaying for a house because you're like, hey, I hate being in my apartment and I want to be in a house, and you're only going to be there for 5 years, that's where we're doing something wrong.
Yeah.
So again, there are various factors that go into that. How long are you going to be in the house? Situations like that. So is it always a great investment?
Or if you know you're overpaying. At the end of the day, I purchased a house last year that I personally feel like I paid more than I would have liked to. And was it a bad move? No. Well, the market, if I wanted to live here, that's what I had to pay. So maybe it's a little bit more than I would have liked to have paid, or I think it's worth, but I wouldn't have been living here otherwise. So, but if you know that going in, at least you're making that decision, with the knowledge, not making it blindly and finding out about it later down the line.
And for the common first time buyer, or just someone who's not educated about the market themselves, is get with a professional and figure it out, and they'll give you an honest opinion. And to be honest with you, you need to find the right professional, because a lot of people, believe it or not, there's still a lot of agents out there who will not give you an honest opinion just because they want to sell you a house and make their commission. To where a good agent's going to tell you, hey, I think it's overpriced. And they're not gonna tell you, or they're gonna tell you the honest answer. So find that guy, go to him. Even if it's not us, we're honest people. Obviously, we're no BS. So that's kind of the point. But anyway, so second myth is you need excellent credit. Completely untrue. Actually, mortgage lenders here in Florida, minimum requirement, even for some assistance, and it depends on the program. So a 580 is the lowest that you can have to be approved. And that's a 5% down, loan product. And then you can get up to $15,000 in credit if you have at least a 620. And that's another program that my girl at Guild Mortgage, Lauren over at Guild Mortgage, just told me about. So she's got a new product. So if you're 620, they're going to give you up to $15,000 in assistance. So
it's not forgivable anymore, correct?
Correct.
Yeah. So they used to, years ago, Florida had a bond program where it was forgivable. And I think it was, correct me if I'm wrong, you had to stay in the house for 5 years or 7?
5, I believe.
Yeah. And they would forgive the loan that you had taken out, and you didn't have to pay it back. Well, I think they went away with that when they saw how quickly the market was taking off. And they're saying, wow, not only are people getting our $15,000 for free, but now their home's appreciated 20 or 30% on top of that. And
correct.
We're going to now make you pay that back. So
yeah. So you can get the down payment.
Ties on as essentially a second mortgage. It's at 0%. You don't need to make payments on it until either you pay your mortgage off or you decide to sell.
Correct. But you do have to pay that money back. But correct. Somebody says, I don't have a lot of cash on hand, which is the case with a lot of young people. I don't have a lot of cash on hand. How am I going to buy a house? Well, you can still do that. Okay. You can do a 5%, 10% down. You can get assistance. Even the lenders will give you a little extra assistance. A lot of lenders will give you 1 or 2% down payment assistance as well as that product. It just depends. So I can't even begin to tell you how many different products there are depending on the companies, but there are ways, and albeit very creative, there are ways to purchase a home without a large down payment. So that is absolutely true. So don't let anybody tell you that, hey, oh, you don't have enough money to put cash down on the house, so you don't even try to go shop a mortgage. Well, don't let anybody tell you that. Get with a real estate professional who has some connections with, I have connections with about 5 or 6 different lenders. I typically use 2 or 3, but if someone can't get something done, I can throw it to them depending on what they're looking for. So yeah, definitely want to have connections with different lenders and what they can bring to the table, because they're all a little bit different too. So you got anything to expand on that?
If you're looking for low or no money down, not that I personally suggest going that route if you can put some money down, but there is programs. VA's offers a 0 money down program. USDA, if you can buy a property here in Duval, you can't necessarily, there's nothing inside of Duval County that will qualify for USDA, nope. But just outside of Duval County, if you want to live on the outskirts of the city or the county limits here, you can qualify for USDA, and that's, again, a 0 money down program. So
a lot of Midwest, a lot of Western states. Well, there's a lot of USDA stuff going on there because it's primarily done on land. Or I don't remember what the actual law is. It's like 80% of the land can be agricultural or open space, and 20% can be habitable by home.
Correct.
Whatever
And
the
then that's
I
on
don't.
like a county average.
Yeah, and
So
that's
because you can
exactly.
buy
And I have no
you can
idea. If somebody wants to correct me on that, please do, because I don't know
yeah.
it. We don't do it here. So
And I've actually been out looking with a buyer at some USDA properties. So you can actually buy in a new community where you would, have again your standard HOAs and everything else, and it looks like a normal community. It's not. You have to live on a farm out in the middle of nowhere on 100 acres to qualify for a USDA loan. You can be inside a neighborhood, but the county on a whole, to your
whole,
point, needs
yeah.
to have those parameters
Okay, so
set
it's
within
based
it.
on the
So
county.
yeah,
So it's basically a rural county,
correct.
essentially.
Yeah.
But they can be subdivisions inside of.
The county, which would then
Got
still
it. Okay.
qualify for a USDA.
Well, I'm glad you knew that, sir, because I did not know that. Because
So,
believe it or not, I've never dealt with that. I have sold in Duval, Clay, and St. John's. That is it. Not a lot of agricultural space in those. So
well,
that's
out you
pretty
can USDA, you can pull that up in Clay County there.
probably
So,
Clay. I figured you could, yeah, some parts of it, yeah. Say what I just
uh,
never had.
same thing up in Nassau County. There's parts of Nassau
Nassau,
County.
yeah,
Yeah.
Nassau for sure. Yeah,
So,
that doesn't surprise me at all. All right, so the third one, which is a big one these days, and a lot of people have them, is you can't qualify for a mortgage with student loans. Incorrect again. The key, or I guess the buzzword or buzz term we're going to look for is debt to income ratio, also known as the DTI. So one thing a mortgage lender looks at is they're going to look at debt to income ratio. So basically, in layman's terms, that means how much you're bringing in every month versus how much you're paying out, whether that's in student loans, car payments, credit cards, whatever you have. If you're below probably 30% or 40% typically, I think it's 40 typically is where their line is drawn. If you're 40% DTI, in other words, you're bringing in $100,000, or let's say $10,000 a month. $100,000 a month would be nice, right? If you're bringing in $10,000 a month and you're paying out $4,000 a month, that's a 40% DTI. So they would say, hey, you're 40%, you're good. We can approve you based on this. You have $6,000 of expendable income each month. That's a pretty good situation. A lot of people are probably closer to 50.
now, it also depends on what loan you're qualifying for, because each loan has a different parameter. So to your point, 40%, I think USDA has a hard stop at 40 or 41. FHA, I think, will go up into the mid 40s, 40,
It'll go higher,
46,
yeah.
48.
Somewhere in there. 50 is kind of where you're getting stopped.
Okay.
That's where you're going to be really hung up. At least when I did do mortgages back in the day, 50 was inoperable for us.
Okay.
Yeah. So, and that may have changed. It's been a few years ago. So I don't underwrite loans anymore, and I'm glad I don't. And I just, yeah, no. Anyway, moving on. So again, if you're a student out there and you have some student loans, pay them first off. Don't just say I'm not paying back the government, because they will ultimately get your money at some point. I had that situation with a friend of mine. He said, "Oh, I'm just not going to pay my student loans. What are they going to do? Take my degree away?" No, but you're never going to be able to buy a house. So good luck. So yeah. Anyway, moving on. You should find a place before you want to buy or before applying for a loan.
Absolutely not. I think we may have touched on this on a prior episode, but the good old golden ticket, as I like to call it, get your pre-approval, figure out exactly what your debt to income is and exactly what you can actually afford. That way you don't go out and go find the house of your dreams only to be let down when you actually go apply to get a mortgage on it and find out that you can't be approved. So
make sure you're qualified.
Yeah,
I won't spend a lot of time on that. We've already talked about that one. But again, it's banging home. Get your approval done. Make sure you know what you can buy, and go from there. So, if you pre-qualify for a mortgage, you can automatically get a loan. So let's explain the difference between pre-qualifying and actually qualifying for the loan. Or getting final approval in what we say in our world. So the pre-approval is basically, let's call it like a surface check or a background check for the bank. They're like, okay, well, we're going to look at everything. They look good. Okay, we can go ahead and give them a pre-approval. Okay, that's the first step. When you actually,
That's
the reason why
that's like your 5,000
that's the
5,000
first
foot
date.
view. They're looking down onto your property. They can kind of see what you own. They know
Yeah,
what your debts are, so on and so forth. Once you put a contract together and you're going to physically apply now to obtain the mortgage to get to closing, now they're getting down and they're walking around your property and seeing exactly what you have there.
absolutely. Yeah. So that's to me, I would use use the terminology. Basically, the pre-approval is kind of the first date to figure out if you're going to go on a second one, and then when you're going to go on the second one and the third one and the fourth one, now we're talking about buying dinner. We're talking about taking you back home to the apartment. Figuring out exactly what's going on there. Okay, and maybe it may not be till the fifth date till the bank says, I don't think you're my type. So and it maybe the sixth date where they said, we can do this. Let's hook up. Okay, so that's kind of the way that works. But yeah, there's a lot of documentation that you're gonna have to send to the banks. They're gonna ask for things that you're like, what do they need that for? It's definitely and depending on how you get paid, there can be certain differences with tax. What kind of tax information you have to give them. If you're a W-2 employee, it's pretty standard because most of America is a W-2 employee. However, that's changing a little bit. We're moving to a 1099 world where a lot of people are becoming their own businesses and entrepreneurs. But that's neither here nor there. But either way, yeah. So there's definitely a lot of different things that go into it, and it is a long process. So it's why 30 to 45 days is pretty typical for a final approval. And us as agents and real estate people is we want to hear the words final approval.
Clear
And
to
that means
close.
clear to
Get me that clear to
close.
close.
Exactly. So that's where it takes. So this kind of goes into what we went to earlier is you need a big down payment.
Yeah.
We kind of already talked about that. No, you don't necessarily need a big down payment. There are obviously places to go that are going to give you assistance. And the other side of that is you hit on it. There's VA, USDA, no down payment loans. Those exist obviously. And there's you can do 5%, 5%
Conventional.
Sorry, I was like, we haven't even talked about conventional loan. You can do 5% conventional nowadays, where unfortunately you're not having a lot of equity in your property. But if it's something to where, like the house that we just purchased, actually, we ended up doing 5% down because we had to keep our cash because we had to put about 30 or 40 grand into it. So in that situation, it worked out for us where we knew that we were going to have equity in the home while doing all the upgrades, remodeling. So we kept our cash, did the remodels, only did 5% down. Boom, we have equity because of what we did to the home. So in that situation, it worked out great. If we were buying something that was completely already redone, move-in ready, then I probably wouldn't have done that. I would have put 15 or 20% down and had equity in the home. So regardless, you want to be able to have a little bit of equity in there as a safety net, just in case something happens to pop. Yeah. So and when I say pop, I'm not talking about zits. I'm talking about the housing market. So
thanks for the clarification.
Just wanted you to know. So the price you see is how much you'll pay.
Also false. Yeah. Somebody sees a house at 200,000, and if you're going under contract at 200,000, they think that's all I'm paying. Unfortunately, that's not the case. So you're going to have closing costs, fees associated with obtaining that loan on top of everything else. So if you're buying something at 200,000, it's likely going to cost you, 205 to 210.
210.
Somewhere in that range, yeah. By the time you're physically in the house. So
at about 5 to 7% more than what the actual price that you're paying for the home. And that's with the down payment of 20% or 10%. I mean, it just depends on the situation. So yeah, you're always going to see, and I always like when a first time buyer sees a settlement statement for the first time and they're like, wait, I thought I was paying $200,000. No, you're actually paying like 209. And why am I paying 209? Well, you have closing costs, you have escrow, you have attorney's fees, you have everything that goes along. You have to pay your taxes up front, your prorated taxes. You have to pay, your insurance, all that fun stuff. So, yeah, it's often a shock sometimes. So we have to explain that to people and how much is it actually going to cost. So there's more than just you're buying more than just the house. So same way with selling, you're selling more than just the house. You're paying for some title insurance, you're paying real estate commission, you're doing all sorts of stuff. So whether you're buying or selling, there's always additional costs
on each side of it. Yeah.
For sure. So we got two more here we're going to get through, and then we're going to wrap this thing up. So this one's always my favorite. You should spend as much money as you're allowed to borrow. If you get approved for $600,000, please don't go find a house at $600,000.
Yeah,
I'll let you handle this one. This is almost more of a personal budgeting thing than anything else. Like, there are a lot of people that get approved for a lot more than what they deserve. And it's less and less nowadays because of the housing bubble that burst, but there's still a lot of that where they get approved for $500,000. Well, here's the deal: do most Americans need a $500,000 home to live in? The flat out answer to that is absolutely not.
Yeah, no.
Okay,
it's really. I mean, I guess it's not a direct comparison, but it's like applying for a credit card, and then you only want the credit card because you're trying to, you don't have the cash to buy
the points. You want to get the points.
Well, you don't have the cash to buy the $2,000 television that you want, so you apply for a credit card, and they give you $10,000. Well, you don't need to go spend the $10,000 at Best Buy. You only want the $2,000 TV. Yeah. Well, but now you can buy the.
And they're going to give you $200, and they're going to give you $200 off because you got the credit card on the TV. Yeah. So now it's only $1,800. So now I got. Are you kidding me? I got $8,200 to spend on this credit card. Fantastic. Let's go buy some other stuff. Yeah. I need a PS4. I need a new recliner with some massages. Like, pick up a new washer and dryer in there. Why not? Right? Whatever. Need a new laptop. And all of a sudden you're $10,000 in debt at a 22% rate. Yeah. But that's neither here nor there. So no, don't go spend everything that you get approved for. It is how much you actually could get to, but you don't need it more than likely in most cases. To be fair.
And this ties right back into the loan process when you're actually going through that. If you're going to push yourself to the limit, keep in mind that they probably put you at a limit for a reason. And if all of your ducks are in a row, and if you're just teetering on the border there, well, if you go to your limit, that may just push you over your debt to income, and you may not qualify at that point. So if you're qualified for 600, and if you purchase something and go under contract at 500, odds are you're going to have a bit of wiggle room there when it comes to the actual approval process, and it's going to be a lot easier for you to get approved for that 500 than trying to push your limits anyway.
Correct. Yep. So that is perfect. So in the last misconception, not necessarily misconception, it is certain situations call for this, but you'll get a big tax break. Okay. So I'm just going to go ahead and take this. I'm going to let you handle a little bit, but while having a mortgage does qualify you for getting some tax deductions, it's not always as great as it sounds. Sometimes the only tax deduction is the mortgage interest, excuse me. If you're a couple and you file jointly, then you cut that in half. So owning a home necessarily isn't the end all be all as a primary residence. Your tax benefits when it comes to real estate really are when you get into some investment sides and you're talking homesteading, you're talking portability, which is another one. We could spend 45 minutes on portability. But we're not going to, because that would bore the hell out of everyone in the audience.
Side breakout one.
Yeah. Just ask your agent if he knows what portability is. And if he doesn't, or she doesn't, then you need to find a new one. But yeah, so there's a lot of stuff with that. You're probably saving as much on your taxes as paying to the bank in interest. It's not really.
Yeah, it's not a direct offset. So and at the end of the day, the better question, if you're questioning anything to do tax wise, talk to your CPA. I'm not a tax guy, so yeah, I can tell you certain places, but they will be often better suited to give you the road to riches than we will when it comes to taxes. The only advice I would say is don't buy a house because you think you're going to get a big check back at the end of the year. That's wrong.
Don't plan on that. So anyway, so that's kind of some myths that we wanted to talk about for first time buyers, young buyers, and just people in general. So just as far as what you need to do to buy your first home, and I think the next follow-up episode we might do Next week is the myths about investing in real estate. Okay, from an investment perspective. So if you're looking at, you already have your primary home, and I want to do a bunch of investing because I hear it's awesome, and there's so much ways to save money and make money at the same time. Maybe we'll do some myth busting on that. So, not that we're the myth busting podcast, but it seems to be a good topic of conversation. So, other than that, man, Ryan, what you got going on today?
Busy week, like anything else. We've got our weekly meeting here with the brokerage in a bit, and
Get on that one too.
Yeah, actually running around this afternoon doing some headshots. So
some headshots,
or I say headshots, not so much of a headshot, less professional, more casual shots around the city. Get some new content out there for the website. So,
gotcha. What did you think about the Super Bowl?
That was a snooze fest, my friend.
I loved it. I don't care. I'm sorry, but
I read somewhere it was a punting contest.
I'm a football purist, so I love defense. And I was, like I said, I coached high school football. I was a defensive coordinator. I was a linebacker, safety, and corner growing up. So defense was what I loved. So I thought it was fantastic. I loved it.
Yeah.
Not to mention, I also bet on the Patriots and the under, so that helped. So I won a little bit of money.
Hey.
Yeah. There's always
one. Yeah. Well, maybe that can be
another myth. Don't invest your mortgage on football games. Probably not a good idea. Real estate is much safer than gambling on football. I will tell you that much.
That I would say. Gambling on any sport, I would. I put your money in real estate before betting on any
I don't know. I've had a lot of success on betting on curling. I'm gonna be honest with you.
I'm more of a shuffleboard.
I'd
rather take it off the ice and stick to my pool decks and some shuffleboard there.
I'm actually kidding, but I did see the fact that CBS Sports has curling night in America on.
I actually enjoy curling.
It's really weird that a lot of people do actually watch it. I don't know what it is.
It's an odd sport, but
I guess the concept of sliding down a sheet of ice with one shoe that slides and one shoe that doesn't. And with a broom, some kind of Harry Potter broom, you're brushing the ice and you're sending massive rocks down ice to hit other rocks is intriguing to a lot.
It's genius, quite frankly.
I mean, I feel like you could drink and do it at the same time. Like it'd be fine.
That's how it was invented. Clearly,
it has to be. Well, it was invented by Canadians. Like they do everything and drink and fish, drink after they play hockey or during halftime.
It's probably how they were killing time while ice fishing.
I mean, dude, they drink Labatt's and eat bacon all the time. So it's just, and if there's any Canadians out there, I really apologize if I offend you, but most Canadians don't take that as offense. Labatt's or, whatever. So anyway, enough about random stuff. So, hey, appreciate you guys joining us. Your final thought, Ryan.
Final thought. Pick up a book, listen to an extra podcast, do some real estate investing in 2019. So
perfect. That's Ryan's. That's the thought of the day. Okay.
That's it. That's all I got. Threw me on the spot. I can't think on the spot.
I know. Read a book. 4-hour work week. 4-hour work week is my recommendation for a book for the next 3 months. Pick it up. Find it. Learn how to automate your business a little bit. I need to reread it again. It's a good one though. So, all right, guys. Appreciate it. Take care. We'll talk to you soon.
We'll catch you. See ya. Thanks for listening to our podcast. If you enjoyed this episode, there's a few things I'd like you to do. Subscribe, leave a review, and head over to nobsrealestatepodcast.com where you can connect with Matt and I on all of the platforms we're on. Also, if you could do us a favor, leave a message letting us know what you enjoyed about the episode and what you'd like to hear about going forward.